Hi everyone, welcome to the second episode of the Talkin Tax podcast, brought to you by myself, Omar Aswat, Chartered Tax Advisor, uh, under the brand name Aswat Tax. Today we have a very special guest. All our guests are special, and today we have Giles from WTT. How are you doing, Jerry?
Good morning, Omar. Thank you very much for having me on.
It's a pleasure. I think we've spoken about this a few times previously in terms of organizing and just schedules always. That's always the issue, right, these days. So, but we're finally here, and it's a pleasure to have you on. I think the viewers, myself first and foremost, will benefit a lot from your vast experience. Tell us a little bit in terms of, a bit of an introduction about yourself. It's not a job interview. You're a veteran in the game. So, but just tell us a little bit about yourself in terms of how long you've been in the profession for and your general thoughts in terms of how things have progressed.
So I started in business commercially in 1983. For the first 10 years, was working in banking and a few other sectors. Wasn't really sure where I sat. I left school without going to university. In 1993, I started training at South Bank Business School in London here as, or it was the start of my Chartered Certified Accountancy examinations. So started as 1993. By 2001, I was qualified and working in industry, and then moved into a boutique tax practice based in a firm of chartered accountants in Tunbridge Wells in Kent. And since then, I've been working in tax, mixed tax, so private client and corporate, smaller corporates rather than the big scale corporates. And ran my own practice from about 2006-07 through to this time last year, when I sold my practice into WTT Group here in the city. So WTT it's a multidisciplinary practice, so it's a law firm, a tax practice, and an accountancy practice. So it's a three-legged stool, and we deal with quite a lot of tax disputes, investigations, inquiries, code of practice 9s, as well as tax advice and planning, legitimate planning, not schemes or arrangements for individuals, families, and smaller businesses. And I'm 1 year in. It was the budget today, so it's a great day to be on this call because we're anticipating what's going to happen later on this afternoon.
Sure. No, that's excellent. Very insightful, very interesting. Just to keep the viewers, with us, we will be discussing, Jeremy's thoughts on the budget. I may have one or two comments. I don't feel worthy to speak in your presence about such matters after all your experience, but
I've just been around a long time and still going.
No, I think experience is a very, it's everything in this kind of industry. But we will be talking about the budget and our thoughts on that, and we'll also be discussing the recent, you could say, controversies in relation to less tax for landlords and Property 118, in which you've been looking into the matter quite closely. So do stay with us. I just had a few follow-up questions in terms of what you've mentioned. So you ran your own practice for how many years would it have been?
17.
17 years. Wow. Clients from all over. Obviously, pre-COVID, things were a bit different, isn't it, in terms of the flexibility. So where would you say your client base would have been?
Yeah, so even though I worked at my home office in Tunbridge Wells. So when it came to COVID, everybody else was forced to go home and go on to Teams and Zoom, but I was already there. So to me, it wasn't such a shift. I mean, obviously it was difficult times for everyone, but it was business-wise, it didn't really change things. I just became more efficient, to be fair, because everyone else was available. But clients came from all over. I didn't really advertise, and I didn't go direct to the taxpayer. I worked as a mixed tax partner for hire, on a pay-as-you-go basis for other accountants, small law firms, and smaller IFA practices. So they used to approach me when they had a client in a sticky situation, or client wanting advice, or had questions that they couldn't cope with themselves. They would wheel me in. That's how it worked. Then I started to get clients come direct through recommendation, but it was predominantly a network of other professionals who didn't have their own tax partners or their own specialists, and they would, rather than going straight to the tax bar, to the barristers, they would come to me first to see if I could, slightly cheaper than going to the barristers. They come to me as sort of I used to say I was a general specialist. So it's that whole mixed tax piece, being on the one hand private client and on the other hand corporate, because most of my private clients had businesses as well as the private client piece. So, and for me, it was a space to be sort of positioned, because it was very, you never knew which, one day to the next was different in terms of client work questions. It could be a VAT question one day, could be a trust question the next day, stamp duty, land tax question the following day. You just had no idea. And that keeps me, we're always, every day's a school day, as I say to my children and anybody else that's listening. So yeah, it's always about trying to keep abreast of everything. And it's, as you know, a complicated subject, taxation, and it's about knowing when to go and get help as well. I regularly instruct barristers on particular matters which are beyond my competencies, and I've been doing this for 30 years, so it's never a failure or a fault to say, actually, we need a better brain on this point than me. I'm happy to do that all the time.
Excellent. Very insightful. In terms of, I just put out a job role yesterday, and I'm looking for that sort of person in terms of, mixed tax senior. So it's exactly as you mentioned, because mixed tax is effectively, broadly speaking, inheritance tax, and then obviously income tax, capital gains tax, stamp duty, land tax if we're looking at property, corporation tax. Because as you say, business owners, they'll have all their taxes, but then at some point we'll have to start looking at succession, isn't it? Which is then where we're looking at capital gains tax, inheritance tax, and matters as such.
Well, and so we'll come on to it with the less tax for landlords, but the stamp duty land tax point, which everybody's missed, is going to be a game changer on that one. I'll come back to that.
We'll come back to that. Okay, you've got me a lot more interested. Okay, that's fine. In terms of last year, you took this step into selling your business into WTT. What was your thought process behind that? Number one, and number two would be why WTT? Just broadly speaking.
So the thought process was, again, it was post-COVID, having seen the impact on some of the smaller practices and the ability to do business in a different way. I realised that I had my own limited liability partnership, and it was my wife and a company, and then my children, adult children, in as members. So it's not, it's me basically. I am the business, and I as a mixed tax partner, spend a lot of my time talking about succession planning, asset protection and succession planning. And I thought with time to think over lockdown, I thought it was time to take some of my own advice and consider the succession of my, what was nearly heading towards 20-year-old private client practice. The succession, clearly, I had a firm that would take over if I were to die, but I didn't have a sensible plan to say retire. I'm not going to retire, I'll die of boredom, but I would I needed to bring my practice, my network and my connections into somewhere else that would then allow it to carry on if I wasn't there. And that was the main drive. It wasn't the money. you'll know, a sole trader, a practice where it's reliant on one person doesn't have a lot of capital value, particularly when you don't do any recurring work, no gross recurring fees. So it was a purely a succession-driven motive. And the reason why here, WTT, multidisciplinary practice. So to be able to offer tax advice under legal privilege, legal advice privilege, is something that I think can benefit, particularly taxpayers who are in, well, let's say coming in from the cold with some serious tax issues. If they go and see an accountant or go and see anybody not a lawyer, then there may be some disclosure issues that might happen sooner than they might like. Whereas I'm an accountant in a law firm, so we have to have a lawyer in the room on the meeting, technically in the room, in order for privilege to extend to the client. But it allows them to come and have a full and frank disclosure conversation at an early stage, and then we can tell them what their position is and what their course of action should be. Clearly, if they then don't follow that, we have reporting requirements then. But it was the multidisciplinary nature of this firm, and I used to send my contentious tax and my codes of practice 9 and 8 here. So I already had a relationship with them. They found out I was looking to find a home, and as we said, it took about a week to do the deal.
Excellent. No, that's you've as you mentioned keywords, which is you've taken your own advice, and I think that's very important. For example, myself, in the last 18 months or so, I've been traveling quite a bit, so I have to advise myself on the statutory residency test. That I literally advise myself, and it's good because you're applying your advice to yourself, which then gives you confidence to then apply to others, isn't it? It's sort of done and dusted or tried and tested.
Well, I think it goes to the old cliche. I mean, it's traditionally estate agents, and I know a few because I deal with a lot of property clients, but estate agents often live in pretty ramshackle and poor houses because they spend their time helping people move into beautiful homes. They don't really have the energy to then do the same thing to their own. So it's a bit like accountants and tax advisors that don't plan their own affairs. Why would you spend your life planning and helping others and not take your own medicine, I suppose?
Exactly. No, it's very important. And for me, it just gives me a lot more confidence in terms of, okay, I've advised myself, I've dealt with HMRC on so and so for my own affairs, and therefore, I can confidently help you as well. So that's extremely important. This conversation can go in so many directions. I wanted to discuss with you the budget. So the budget will be on in a few hours from now. And obviously we know over the last couple of years, the budget goes one way and then 6 months later it's going another way and back and forth and the rest of it. Obviously with the politics in the UK as well, that's a different angle. We can spend another hour talking about that, but that's not the point here. So in terms of the budget, what are your thoughts? Just generic thoughts. A lot has already been leaked in the press. I think a lot more has been leaked in comparison to previous. Yeah. So.
I think there's definitely an idea that I was listening to a journalist the other day saying that they've never seen so many leaks regarding the budget, but they said it's almost as if they're trial running or road testing the ideas by leaking them and seeing what the reaction is on social media or any other media. And if it's not favourable, then they pull that and leak something else and see if that floats. And it's just they keep doing it. So my general view on this is that I think it's an accepted situation that we've got the highest tax take for 70 years. So that was post Second World War. So we are paying a lot of tax compared to where we have been over the last few decades. Fiscal drag has caused a lot of that. freezing all the tax thresholds, particularly inheritance tax, is causing an increase in a windfall, if you like, for government. Knocking a couple of pence here and there off national insurance is going to benefit the workers to the tune of a few £100 a year. Is that enough to buy enough votes to flip the sort of opinion polls? I don't think so. I also think that Labour have been talking a lot about the non-dom tax system, which is, we won't go into that now. It's a topic of a week's worth of topic on its own merit. But I think what we're going to see.
Give us a little bit, yeah.
Well, I think Jeremy Hunt is going to steal their thunder. I think Jeremy, given this is his probably last budget before an election, he's going to steal a lot of their ideas, including changing the non-dom system and making it less advantageous. I think he's going to steal a few of their ideas so that they can't then say, well, you know, we're going to rip up what he did, because effectively he's going to do what they were going to do. So I think there's going to be a bit of political shenanigans going on with that. Bottom line, though, I think, like I said for the last budget, the spring, I said it just was boring. There was nothing really. There's tinkering around the edges. Nothing really happened of any interest. We're just still paying more tax than we've ever done in my lifetime. So, and that's, I've been around since the 1960s. So, not paying tax so much, but I remember the Labour governments of the 70s and the 2000s, and I remember all the Conservative. I remember the Conservative government. Who was it? John Major, Chancellor, cutting 1p off the main rate of income tax, and also shaving the personal allowances. So the net effect was you paid more tax.
Seriously?
I thought that's ingenious. He said, the Daily Mail and the Sun have put 1p cut in income tax, hooray! But you actually paid more. Thought there, wow. This is where I started getting interested in it. I was the only person in sort of at school in the 70s who used to watch or listen to the budget, and people going, I was obviously destined to keep doing. I'm about to do the same thing this afternoon, sit and watch it. But I think he hasn't got a lot of room. I think anybody doing anything fundamental with the tax system now is, it wouldn't stand. It would simply be torn up and start again with a new whoever comes in next. I can't see anything. Even any giveaways will not be sufficient to amend the position. I think they are. I know we were going to talk the politics, but I think they're toast as far as a party. So we're looking at what Labour are going to do, and Labour, how can you increase taxes anymore on the work? Exactly. It's impossible.
You mentioned that we're paying a high level of tax, record numbers, and we're seeing business owners, high net worths, they're starting to, obviously realize these sort of angles. And I see a lot of, business owners and the rest of it thinking about moving offshore, for example. Yeah. Now, the point around that is, what are your thoughts in terms of that? So we're already paying a high level of tax, number one. But then at the same time, this budget that is due to be announced, they're talking about scrapping the non-dom status, the remittance basis I was reading about yesterday. So it's like we're just going more, and it's just becoming more and more negative. And I'm just trying to understand.
I don't understand what's going on either in sort of policy terms. Why are you trying to strangle the economy and make people pay more for less in tax terms, when what we should be doing is reducing the tax rates, freeing people up to employ, grow, expand, both here and overseas. Instead, they're just going to make it less attractive from a non-dom's point of view, someone who's non-domicile coming to the UK. Why would you choose to set up somewhere else? What I see, a lot of the calls I get to deal with here are people who are saying, right, I'm going to set up overseas when they are UK resident, UK domiciled.
That doesn't work.
Well, I say to them, you can do what you like, you can set up where you want. I said, but the tax treatment will not be what you expect. And they don't they don't know, which is why they're hopefully talking to me before they've done it. I get the occasional call, oh, I already have an overseas, I have a Dubai company, it's made a few £1 million, I haven't told the revenue. And you're thinking, right, legal advice privilege first on it. Let's talk about that with the lawyers in the room, because that's problematic. And we could go into why, but no, I think the policy, I don't understand it, and I've been around this game a long time. I don't understand. Rishi talks about being the party of tax cuts. Well, they're the party that's delivered us the highest tax rates for 70 years, and knocking a couple of pence here and there makes no difference in the long term. They're still we're still paying more tax than ever. And if we try and go anywhere else with it, move the business abroad and stay in the UK, you're still going to pay UK tax. So people are beginning to decide, right, I am off. So we're dealing with, I'm exiting several. I've sent a couple over some to Portugal, some to Spain. These are individuals. Business over to the Philippines. It's quite interesting one, that. Australia, New Zealand, South Africa, and where's the latest one? One to Switzerland, and the other one's heading off to, it's another one to Portugal. So, and these are just people who ran businesses in the UK for a long term and have just decided enough. They are packing up and taking their business with them. How they do it and how they don't, everybody says, oh, I can have split year treatment if I leave tomorrow. And you go, well, yes, but split year treatment is a concession. If the revenue decide it suits them for you to be tax resident till the end of this current tax year, that's gonna cause you some problems if you decide to wind up your UK business or take the dividend income from your UK. I had a guy that this is a quick story. I did a TikTok talk about leaving the UK, and I got 230 odd thousand views of it, and a few quite a few.
I was actually going to come onto the TikTok then, your thought process around that, but that's interesting. 30,000.
Yeah, on just one post. I mean, I had other views on other posts, but this was one post that went significantly more than the others. And I spoke to a guy who's in Portugal, who had sold his UK business to his holding company whilst he was in the UK. So a cash holding co. He moved over to Portugal, waited for the tax year to roll over, took all the money out by way of a dividend as a non-resident. He said he was coming back at the end of the following tax year. And I said, why are you doing that? I said, you'll pay UK tax on the dividend when you come back. No, I won't. I've been told I can be out for 12 months and it's fine. I said, would you like to tell me who told you that? He wouldn't give me the name. I said, you've got to be out for 5 years, probably from the end of the tax year, not 5 years from the date you depart. Given split year treatment probably wouldn't be given to you. And he said, well, there's loads of us out here in wherever he was in Portugal, all doing the same thing. And I said, perhaps you might like to organise a group call. We could have a discussion about what actually is the right answer. But again, so much misinformation. But it's amazing what TikTok brings up. I've had several instructions from doing it. I've had several dead ends, and there's a lot of free advice being asked for out there, which is fair enough. I mean, a lot of it's fairly simple question and answer. But no, it was an experiment from here to see whether it was worth going on TikTok and other social media, doing video talks and vlogs and that sort of thing. And yeah, I think the general answer is yes, you get a lot of noise, a lot of traffic, but actually you do get some decent work out of it.
Sure, I would agree with that. Social media is the way right now, and it's the way forward as well. But as you say, it's just that whole balance between wasting a lot of time speaking to tire kickers, for example, and then actually again working. So it's just that whole balancing act. But no, that's very interesting in terms of that situation you mentioned, because we know that the 5-year rule applies for disposals for CGT purposes dividend distribution from closed companies, as you mentioned in your story. And also the fact that split year treatment, if you become UK resident in the next tax year, then split year treatment cannot apply in the current tax year, right? In the first instance. So, you know, there's a lot of technical points that have to be looked at. And I always bang on about it in terms of when it comes to anything offshore, so coming to the UK, leaving the UK, this, you know, top of my head, I can think about 10 different angles that need to be considered or that require some sort of professional input. You know, I have, you know, spoken to potential clients or even clients previously where they've read on the internet about the statutory residency test. Okay, fine, you know, 30 days in the UK or 183, whatever. But then if you're moving out from the UK or you're coming into the UK, that's not the only thing you're looking at, right? You're looking at so many other angles. For example, domicile is a whole different world. You know, you're looking at remittance basis, foreign tax credit relief. How are you going to be taxed? You know, if you've come to the UK but you've still got offshore income, and vice versa. The employment taxes, national insurance is a complete different minefield. So yeah, I think as you've mentioned as well, I've seen some of your posts as well, where you know professional advice must be sought. You know, we're not sitting here just to, you know, for show. We're sitting here because there's an expertise.
I've managed to build over my years. I've built relationships, professional relationships with offshore service providers, and some of the fairly big ones, because they don't give advice. They don't give tax advice to people that want to, for instance, set up an excluded property trust or an offshore company structure. So because of the internet and everybody having a website, a lot of traffic, a lot of customers go directly to these offshore service providers, if they're UK based, for example, and say, I want, can you sell me the following? And they have now taken a view that they won't sell anybody anything until they've had or seen written UK tax advice. So I get individuals coming back to me and going, can you help me with this before I go over there? And then I get the trustee companies, the service providers themselves, directing their potential clients back to me saying, these people need your help before they come and sign up with us. And sometimes it's a non-starter. You just say, well, you know, it's not going to work. You can do it. You just do what you like, as I say, but your tax effects will be probably worse than if you stay put. Or we just re-engineer it and say, do it this way. Why not set up a subsidiary or an agency or a branch or something, a permanent establishment, but set up a group with an offshore company. That's more. It depends on what the actual ultimate beneficial owner wants to do and how they want to be paid, how they want access to their money, and where they want to be in the future. Physically, as in where they're going to live.
Exactly. And it's like you say, where you know, I get similar calls as well in terms of the common one. I think these days, because of social media, is, you know, set up a company in Dubai, for example. It's become a bit of a hype, which I don't really think is ideal in the sense that, you know, that the move to Dubai, for example, obviously it can be to any location, but the move to Dubai, if we're just talking from that perspective, just to keep in context, you know, as you mentioned, you can't be sitting in the UK resident, born in the UK domiciled, everything's in the UK. You set up a company offshore, and this has been made quite clear that you set up a company offshore. You can do that, as you mentioned. You can, as in sometimes people ask me, can I do this? Can I do that? Well, you can do whatever you want, right? In life, you can do whatever you want. Yeah. But from a tax point of view, did it help you? Is it beneficial? And that's where, you know, a lot of the times, if you
it's the consequences. You have to take the consequences of your action. And we'll talk about property, the landlord, 2 landlord schemes that have blown up. That's these people are now suddenly understanding that the consequences of their actions are far way beyond what they had no comprehension of this, and now they're stuck. But exactly. It's the same with going offshore. You can do what you like, set up where you want, nothing to stop you. But it won't necessarily be any more efficient. It might be worse.
Exactly. And obviously the transfer of assets abroad legislation and the anti-avoidance provisions are very broad and vast.
That can catch the 1930s. I keep saying to people, it's not like it's just been thought of. It's you know, you set up a company in Dubai, following on with our example, that Dubai company makes £1 million profit, leaves the money in Dubai, no remittance. UK resident, UK dom under transfer of asset abroad rules, you are deemed to have received those profits and will pay a real income tax charge on that deemed distribution. That's why it's worse than it could be. You haven't received
the funds.
You've got a deemed remittance with a real. You can't deem to pay the tax bill. You've actually got to write a check out or make a transfer. So it's, that's why it can be worse than you think, because you think you're leaving your profits outside the UK. Never mind the non-disclosure and the tax evasion that's going on there. That's where the legal piece comes in, and that's where how you then approach the revenue to repair that situation. Have a client that rang me again from TikTok, did a piece about nudge letters, and got a few thousand views, nothing like the 200,000 on the other one. 2 calls within 2 days, 2 people receipt of nudge letters. And then you dig, so it's a bit like going to confession at the Catholic Church. You sort of slide the shirt, what have you done? And they go, oh, well. And you think, oh, no. And you're thinking, Christ, we've got to go down Code of Practice 9 here. These people are sat in the UK with millions of pounds of value overseas, and they haven't told the revenue. They've done nothing. And you're thinking, oh, and what they've done actually is remit some of the money back to the UK to buy a house or buy an expensive car. And of course, the balloon goes up with the bank tell the revenue use their Connect system and go, oh, hang on a minute. And then it all starts, then the pain starts.
Exactly. I think people need to realize that HMRC, government organization, they have access to all sort of entities, especially banks. Banks is the key one.
Well, it's Common Reporting Standard and Connect. They're two. All the information flows in, metadata. They might spend years trying to deal with it and get to it, but their Connect system is now the #1 tool. So as soon as anybody receives a nudge letter, you can bet that the Connect system has already gone through their affairs, and the revenue know more about you probably than you actually have forgotten about yourself. So, wow. So that's why you shouldn't ignore a nudge letter. And one guy, again, TikTok post, rang me. He had Schedule 36 notice letter, so we want information. I said, when did you get that? He said, oh, 2018. I said, do you realise there are daily penalties for failing to respond to that? Oh, are there? I didn't know that. So anyway, I've suggested he come in for a physical meeting, and we put the lawyers in the room on that one as well.
Excellent. As you say, the nudge letter, for example, you say you may need to pay capital gains tax, but what that actually means, it sounds generic, but what it actually means is they've got information from, their systems, and, now they're pushing it back to you now. Let's see what you're going to do. Are you going to,
yes, and then we have a phrase for that in our bit. Well, in my old business, we used to say, give people enough rope to hang themselves, because they say, we don't think it's a classic behavioral psychology play here. We don't think your tax affairs are in order. We invite you to repair the situation within the next 30 days. And we're going, and we have people say, well, which bit do I need to tell them about? And they're saying, all of it. Because if you fail to disclose, they already know where you are. They are now inviting you to tell them what you think is wrong, and hopefully that is all there is. Exactly. So I don't have to tell them about this bit. No, you have to tell them about that bit as well.
About everything.
Otherwise, it will become a criminal matter, and you will end up in prison. That's what we say. And people think, oh no, that can't be right. So no, this is a serious matter. Do not treat it like. I know I'm laughing, but it's you have to get humour in these, because it can get quite grim. Taxpayers can end up in pretty horrible positions, but we have the knowledge and the skills to help them, but they have to be prepared to pay for advice. And it's the same old problem. Can you do it cheaply? I always say, well, which bits do you want me to leave off?
Yeah, exactly. In terms of this Connect system, is it it's an internal system, right? But have they started to utilize AI within the system?
Yes, they have. It's AI, so it can very quickly trawl all public record, all banking records, email traffic, social media posts, which is the one that tends to catch a lot of people out.
Wow.
So when you post your holiday pictures from the Bahamas on your Facebook page and pictures of your new Porsche and Rolex watch, etc., that might not match with the £4.50 profits you declared in your tax return for the last 3 years. So, bingo, there's a nudge letter. We don't think your tax affairs are in order. What are you going to do about it? And people just, the penny hasn't dropped yet.
It hasn't. You mentioned the key bit there that I sort of picked up on, which is email traffic. That system can also access, emails.
Encrypted email. I'm sure it would be able to go. So if you're using Outlook or anything of that sort, it would be able to get in there as well.
Sure. Okay, just a quick one before we get to the main topic, main event, which is less tax for landlords and Property 118. But in terms of the abolishment of inheritance tax, there's been talk around that here, there. Every budget, inheritance tax needs to be abolished, or it might be abolished. What are your thoughts around that? My personal view is that I don't think it'll be abolished, and you may have a different view. But I don't think it'll be completely abolished. I think the nil rate band definitely needs to increase in terms of, we know that it's been stranded since 2009 and frozen until 2028, which I think is ridiculous. I think it should increase. But completely abolishing inheritance tax, I think that's a bit of a too far stretch. I think there's other ways they can sort of, assist taxpayers, and the abolishment of IHT is a bit far-fetched. What are your thoughts?
I don't think they'll abolish it. If they did abolish it, Labour would put it straight back on after the next election, and the next budget. So I think it's just noise around the budget. I think they're not going to do that. If they did do that, they would probably also abolish the capital gains tax uplift on death. So
Sure.
Give with one hand, take away with the other. They'd step up in value on death for capital gains would also go. No, I don't think. Given that out of all the taxation, all the taxes that there are, inheritance tax generally is voluntary. If during your lifetime you can't get rid of it completely, but you can take steps during your lifetime to significantly reduce IHT with potentially exempt transfers, setting things up from the get-go in the right way so that you don't create the value in your estate, it goes down the generations. So, what was it? A chancellor from way back. Inheritance tax is paid by people that distrust their heirs more than they hate the revenue.
Mm-hmm.
Something like that. It was one of the chancellors from 80, one of the Liberal chancellor. I can't remember who it was now. Name will come back to me. But it's one of those things that is true. You don't have to pay it if you take the right advice and right steps. It's hard to shift value when you've got a lot, and this is when most people come to us as private client advisors and say, right, we've got all these properties, we've got all this interest, we've got all these assets. How do we rearrange it to make it more tax efficient? And you say, well, why didn't you come to me 10 years ago? We could have actually set that up tax efficiently, and then we wouldn't be having this conversation now. Because to move all of this is going to create some tax liabilities. But, people,
exactly.
Human nature is to come after, so we just have to deal with it.
With inheritance tax, it's right what you say in terms of the sooner, the always better. So, there's different stages where you can seek professional advice. And as we say, do what you want. But, if I've had people come to me after death, and yes, there are still sometimes things that can be looked at or considered, for example, a deed of variation. Yeah. But, so you've come after death. And then there's those that come, someone's terminally ill in the family, and then they're seeking advice. Again, very limited. We know the 7-year rule, for example, as a potentially exempt transfer. So you're very limited. And then, as you say, if you come from the start, which is even pre sort of structuring in the right way from the start, that's obviously the best. And then anywhere between that and as early as possible is
I always
ideal.
say to people, you know, the revenue don't like shifting. Revenue don't like income shifting, value shifting, asset shifting, profit shifting. So just shorten it to shifting. They don't, if you shift something from A to B, they're looking to see whether they can tax the shift. So don't do that. Do it, build something which you don't, then doesn't result in a shift. Or if it is a shift, it's a real gradual growth for younger generations. And also have lots of different, don't just go family investment company or family trust, family partnership. Have one of each, because governments can't help themselves but tinker around with all the different tax rules all the time. So if you've got all your tax eggs in one basket, the chances are if it gets knocked over by the tax changes, then you're done. You've got to start again with value, which you've got to shift somewhere else. So spread your, a bit like investments, spread them into some low risk, mid risk, and I'd stay away from the high risk tax work, because that's that's where people get into big trouble.
Mm-hmm. Interesting, very interesting. In terms of the recent controversies with Property 118 and less tax for landlords, the lawyer from, is it Tax Advice Networks or Tax Policy Networks, Dan Needham.
Yeah.
Dan, did you have contact with him, personal contact, or?
Yes, we know Dan. We know Dan.
Yeah, so he's obviously his association have delved into certain matters. Well, I'm not sure how the background in terms of did they actually go ahead and delve into it, or did some sort of information come to light? But regardless, the bottom line is less tax for landlords, for example. I have no connection with them, no association with them. They've been selling certain schemes for particularly in the property arena, which is around, for example, setting up certain structures, which therefore means that they're promising certain tax benefits, which, quite frankly speaking, are not there. So what are your initial comments, and then we'll get into the details.
So both of those, so the less tax for landlords and the property 118. So less tax for landlords was one scheme. It was a hybrid LLP, so an LLP with a corporate partner. Property 118, from my lesser study, I've been really focused on less tax for landlords in the last month, but property 118 was 4 different schemes, I think, 4 or more schemes, 3 of which have now been issued with scheme reference numbers under the DOTAS, Disclosure of Tax Avoidance Scheme rules. It's a late register. The sellers of the scheme didn't register, but as a result of Dan Needle effectively blowing the whistle on both structures, both promoters, the revenue have acted. So Spotlight 63, Spotlight being HMRC's sort of shop window for tax avoidance schemes that they believe don't work. Funny enough, there've been 63 spotlights so far, I think. Spotlight 63, the last one, was aimed at less tax for landlords on the basis that there's an awful lot wrong with it. I'll come back to that in a sec. So these should have been registered, all of them should have been registered as tax avoidance schemes and were not. Late registration under DOTAS means several things. It means that the revenue will probably fine the promoter for failing to comply with DOTAS disclosure. No one really cares about that, to be fair. Taxpayers certainly don't. What they will care about, though, is that then they will be forced to hand their client list over to HMRC. HMRC will in turn issue a scheme reference number. They haven't done so yet for less tax for landlords, but that will come. the promoter must give that number to the individual, who then must put that on the next self-assessment tax return. And that's the way of linking the clients with the scheme so that revenue can then go and investigate, or the normal route to start with, accelerated payment notice.
Okay. Okay. So just before we continue, there's a few things to unpack there. In terms of okay, you mentioned APNs, for example. Just explain to the viewers what do we mean by APNs, and what's this whole thing about? Okay, it's tax avoidance, but you're allowed to go through the scheme, but you just have to disclose it. So we'll just double check it. So what's the reason of going around in a sec?
APN is another, we do like our acronyms in tax and law, but accelerated payment notice. That is a notice, effectively it's a bill, payable within 90 days, no rights to appeal, no recourse to any courts or tribunals. It's a system that came in as part of DOTAS, Disclosure of Tax Avoidance Schemes, where the rules are now, if you devise and promote a tax scheme, so if you and I together devised a scheme, we launch it on the open market, we have 5 days to register the scheme with HMRC under DOTAS rules. We have to give them the whole scheme documentation, the legal opinions, chapter and verse. They would issue us with a scheme reference number.
Okay, is this so? So you and I, we're sitting in a room, we're sitting in an office. We devise a scheme. We devise a scheme. We take legal opinion, we take formal opinion, and we put a scheme together. Now, does this need to be registered prior to the scheme going on open market, or
it's within 5 days of launch?
Within 5 days of launch. Okay,
that means basically straight away.
Straight away, effectively, exactly. And then, okay, HMRC will then look into the paperwork that's been provided.
Well, actually, I think you're giving them a bit too much credit. They simply give you a scheme reference number. They haven't actually even opened the file, I don't think. They just go, here's a number. And you give that number, you must give that number to all your customers.
Mm-hmm.
And it's slightly advanced now, the DOTAS. If you buy a scheme now, you actually pay the disputed tax or the saved tax up front. That's pretty much killed most schemes. Most people don't want to do that now, but back in the earlier versions, you didn't actually pay the disputed tax until you got an accelerated payment notice. So as soon as the revenue knew there was a new scheme on the market, they would then go and look at the paperwork and try and understand what it was and how it worked and why it probably didn't, in their opinion. But in the meantime, the point of an accelerated payment notice was part of the 2011 policy under the coalition government to level the tax playing field, to disrupt the tax avoidance industry. And the way they thought the best way to do this, answer this question, why do people buy a tax avoidance scheme? Why do they enter into tax avoidance schemes in the first place? Because it kicks the tax bill down the road until the scheme is defeated in court. Assuming it is going to be defeated. If it wins, great. If you win the day, you keep your tax savings. Often they're defeated in court, often that's some 5-7 years down the line. So the revenue.
So you've enjoyed the tax benefit, basically.
You enjoy the benefit of the cash until the tax is due some 7 years later, but by that time you've probably spent the money better than the government might have. Well, that's just a political thing to say, but you might have done better things with the money, to put it that way. So the revenues idea was, okay, let's disrupt the tax avoidance industry by making the alleged tax savings. We'll take the money now. Money up front. We'll have the money under an accelerated payment notice, and then you can come and argue your case as long as you like, for as long as you like, and we will defend it, defeat it, and ultimately we'll keep your money. But what it did was it took away the incentive for the punter, the taxpayer, to even think about, if I'm going to pay the tax up front and the fees, I'm not going to bother. And it has, to a lesser degree, had an effect, but Less Tax for Landlords Property 118 decided that they didn't need to register their scheme.
Okay, so I just want to, so I've sort of, there's a bit of a flaw there So in the sense that, it's like self-assessment where you and I, we're sitting down, we're devising a scheme. Now it's up to us to decide whether we're going to declare this scheme or not, right? It's up to us. It's self-assessment. So at what stage does one decide that this is something that should be declared and this is something that shouldn't? Because it's self-assessment, right?
It is, but it's. I mean, the rules are there, and if you're if you are a regulated person, subject to the professional conduct in relation to taxation, or the PCRT rules, which any qualified tax advisor, lawyer, accountant, trust and estates practitioner are all governed by this sort of super ethics umbrella of PCRT, means that you have to follow the rules, but some don't. The risk of getting it wrong for the promoter is, I think starts at about £5 million fine.
Wow.
However, if you're going to make multi-millions in selling a scheme, is that not a cost of doing business? That's a rhetorical question. Unless Tax for Landlords took that view, they have decided that it was worth flogging their scheme from 2017 through to a few months ago, when they had to shut the shop for new business because of Dan's work and Spotlight 63. They were selling.
Okay, so effectively, it's basically it's possible, as in obviously we don't know, but it's possible that certain individuals or organizations, they set up a scheme and they're happy to take on that risk space. That's effectively what it is, right? And they make the money and then take obviously at the end of the day the taxpayer is the one that suffers, isn't it?
Yes,
brutally. Yeah.
And often, as happened with, so we're at this stage where there's groups of individuals who are clients of, or ex-clients, or soon to be ex-clients of OCG, One Consulting Group, Less Tax for Landlords, Chris Bailey, SKS Bailey. There's a whole group of companies that are all involved in this. Some to a lesser extent, but the clients are, and there's about 500 or so, and some have been in from the day one, and some have joined back end of last year, 2023, and haven't yet filed any accounts or done any reporting. So some can effectively exit quickly with little consequence, and others are now really caught out, because these schemes, they're sold on the basis that they've got counsel's opinion given to the promoter, and that the individual buyer, the taxpayer, doesn't need to go and get independent advice on the scheme. And even if you tried to get independent advice, the promoter would not give you the scheme paperwork, the instructions to counsel, a copy of the opinion. They might show you a redacted copy of an opinion, but that's no use without the instructions. You don't know what questions were asked. So they rely on people not doing due diligence, proper due diligence on what they're about to buy. They've spent £15,000 or £20,000 a case going in, times 500, you could do the numbers on that, it's a few million, and they're paying £450 a month, or thereabouts, plus VAT, to have the accounts done by the promoter. So you're not
for that accounts.
£450 a month. And this is for LLP accounts, limited company accounts, and some tax returns. And all they're doing is renting out property, so it's not. However,
that's quite high.
So that's £2.5 to £3 million income a year, and they've been doing this since 2017. So you can see now that the cost of failing to register it as a scheme, they ran the risk, it's backfired, but they're still in front quite significantly, I would suggest.
Okay.
The problem with it is, of course, we've been for the last few weeks since since Spotlight 63, we've been carrying out our own technical and legal analysis of the scheme, looking at it from the point of view of a declaration of trust, supposedly, without informing lenders that you're moving beneficial ownership of your property portfolio. That's potentially in breach of mortgage terms. That has catastrophic consequences, potentially. We've got
Is that from a tax perspective or a mortgage perspective?
that's a legal perspective.
Legal perspective.
Yeah.
Okay.
So less tax for landlords put it in on public YouTube videos and on their slides and their presentations that you don't need to tell a lender when you move beneficial ownership. That's a very bold statement to make because you've got to read the terms of your mortgage. And most mortgage conditions say that you will not transfer interests in your property without permission of the lender.
Okay. I think Property 118 we're doing something similar, isn't it, in terms of
they have similar versions, but a lot of it revolves around the same sort of thing: moving beneficial ownership, don't tell the lender, and then share profits. So the basic problem here is something that was covered by a targeted anti-avoidance rule in 2014, which was mixed partnerships.
Exactly. I was just going to say, in terms of in terms of my CTA exam, the owner managed business one, we had a 17-mark question and then a 3-mark question, which was exactly around the legislation. And this is prior to the exam being open book, so we had to sort of, it was slightly different. We couldn't just type on the internet. We had to, we had to know where it was in the legislation. So
Section 850C, ITOIA.
Yeah, exactly. So we had to basically, for 3 marks, I had to basically find this legislation, which is the hybrid partnerships. And broadly speaking, in a single sentence, is that it does not work. And I've always had this view. So even before I heard about less tax for landlords and the rest of it, for me, I've had a couple of clients previously ask me about, you have a LLP and then you have limited companies on top and you divert income. And my answer has always been straight because of this question in my exam, which it just stuck in my mind since then, back in 2018.
Up until 2014, well, up until December 2013, to be fair, because it was the autumn statement that stopped it. It came in Finance Act 6th of April 2014, but it was effective 6th of December 2013. There was anti-forestalling rules added. But prior to that, from 2001, April, LLP Act 2000, effective 1st of April 2001, but with those 13 years, you could go into partnership with a limited company. You can still go into partnership. It's not illegal. It's still a structure. You can do it again. You can do what you like.
As we say, yeah.
You start sharing all the profits, and the less tax for landlords model is most of the 90+% of the profits each year go to the limited company to pay corporate tax on. You can't do that. The anti-avoidance rules from 2014 say excessive profits shared will be reassessed on you as a person to income tax.
Correct. So if the company's provided some sort of capital, for example, is actually doing something for the partnership, then there's a slight justification in terms of, yes, certain profits can be allocated to the corporate partner. However, the problem here, and correct me if I'm wrong, but the problem here is once you become excessive, which is, the corporate partner is doing nothing except sat there as a legal entity.
So the anti-avoidance used the term money box, so that the corporate partner was nothing but a money box. In partnership terms, it didn't bring anything to the party. It didn't provide any services, any capital, any land, labour or enterprise. It was simply a money box. So it just received the profits on paper, paid corporate tax. So that's the basic mischief. So that's where the revenue, when they fired the gun, or sent the flare up on Spotlight 63, that's what they thought they were dealing with. And that's what we thought they were dealing with. But having done some investigation work, along with Dan's help and some digging around on some of the schemes or some of the clients and getting their documents and seeing what actually happened, and then listening to some of the post-Spotlight presentations by the owner of Less Tax for Landlords, there were several things that were just completely, I think Dan described it as either catastrophically incompetent or a fraud as to the advice that was given to people that went into the scheme. It was.
He likes his terminology, right?
That's Dan's terminology. It's public record, so I'm not getting anything out of turn here. First thing they said was that it was an uplift in base cost for capital gains tax purposes going into this LLP. So people have sold properties from the structure and paid no
Okay,
capital gains tax. So we know that's
yeah,
that
I'm sorry. My question. Yeah, exactly. As in terms of documents you've seen and the rest of it, how have they justified that? Because that is, as in obviously for us, that's extremely basic knowledge that the LLP and the personal individual, is transparent for tax purposes. So it's like the same person, isn't it?
Well, their view. I haven't seen the formal advice. It just was said that because it's an LLP is a body corporate, which is technically true, but an LLP is still a partnership for tax purposes and for many other purposes. No, they said that when you put your properties in on the balance sheet, you wipe out the capital gain, and then you can sell them with no tax. So all those that have sold have suddenly realised they haven't paid the right CGT. Problem. They've been told subsequently that doesn't matter, and this was said a few weeks ago, you can roll over the gain into the acquisition of more residential buy-to-let property.
Wow.
Now, again, this is a chartered accountant, not me, the man behind Less Tax, standing up in public several times saying this very point. I won't say what I said when I heard it. It's after the watershed. Utter nonsense, I think, is how I would describe it at this time of day. You can't. The only rollover you might get is into furnished holiday lets. And as we know from what's been leaked about the budget, that's going to be possibly knocked on the head this afternoon. So it won't work anyway. The next thing they said was, 2 years after buying this structure, this scheme.
Business property relief.
Yeah, business relief for inheritance tax purposes. So the whole lot becomes exempt from inheritance tax. Again, I won't repeat what I said when I heard that. Utter rubbish. And the last point, back to the corporate again. So the corporate's getting all the profits each year. There's a couple of things wrong with that. That is a change in your interest in a property investment partnership, a PIP. And now I'm moving into the Finance Act 2003, Schedule 15, which is stamp duty land tax. So it's by definition, these structures, this scheme is a property investment partnership. It's a partnership where its main activity is renting residential property. So it's a PIP. Therefore, when you change the profit sharing ratios each year, it's a transfer of your partnership interest and is subject to stamp duty land tax. Each year, you change the ratio. So someone that's been this came out in a call last night. Dan Neagle, Ray McCann, and a stamp duty land tax specialist who I don't know, with about 20 clients on the video call, exploring the stamp duty land tax effects of being in a less tax for landlords hybrid partnership, or a PIP for that point. Nobody knew about it. Nobody knows about it. It is going to bankrupt a significant proportion of the cohort.
Wow.
The only saving grace is if the declaration of trust, or the letter of trust as it's referred to by them, if that fails, if that doesn't stand up, then the partnership is effectively voided. It doesn't exist. It can never have existed.
Okay.
We have taken legal advice on the letter of trust.
Yep.
Our view is that a court will be the final arbiter of whether it works or not. It does what it says it's going to do. The intention of the parties, the document, the way it's signed, it's not a deed. It doesn't have to be a deed. If it's transferring beneficial ownership, it can be a piece of paper. If it's transferring legal ownership, it must be a deed.
Yeah.
It's a technical argument, but it's now turning out to be the most important of the arguments because if it stands, stamp duty land tax is in play, as well as the capital gains tax and the extra income tax. The revenue have agreed with me already that they'll, in a contract settlement for the outstanding tax liabilities, they will allow a deduction for the corporation tax that's already been paid.
Okay. Okay.
That is the only piece of good news that we have in this sorry affair.
Jeremy, I need to. There's a lot to unpack there, so I'm going to unpack it one by one. So you mentioned 4 particular areas which are in your words at particular times of day utter nonsense or utter rubbish. Okay, number 1 is the CGT uplift in base cost. Now we've mentioned that their argument is it's an LLP, therefore limited liability partnership. Therefore, I don't know if, correct me if I'm wrong, but are they taking the sort of view that it's like a limited company, therefore separate legal entity? But for tax purposes, quite clear that it's not, right? Which is the partner in the LLP and the individual is the same person for tax purposes. Just for viewers' sake, you have yourself as yourself as an individual, yourself as a partner. Your profits from the LLP is allocated to each partner. That figure then comes onto your self-assessment tax return in your personal capacity, and therefore transparent for tax purposes in the UK. So that's fine. So that's, as you say, incorrect. Number 2 is that certain clients of this firm were getting the uplift into the LLP. Once they sold the property, they were then claiming rollover relief at the same time. Now, obviously, the two are not.
No, they have.
It's
They
either one
weren't.
or the other, right?
No, this was where Less Tax for Landlords leadership team finally admitted that the step up wasn't true.
Exactly.
Therefore, there's a huge capital gain now because it was the original base cost and the sale price used in the calculation, not the step up value to there.
Sure.
But to mitigate that, it doesn't matter that they were wrong. You can now roll over into new purchases of residential buy-to-let.
Yeah. So effectively, what they're doing is they failed in one area. They've realized that they failed, so then they've just picked out another piece of legislation and applied that, just so that obviously clients would have caused a massive fuss. You've advised us that there's no capital gains tax, but now we have to pay. So obviously they've had to sort of, which is rubbish again, which is used the rollover relief.
It is, and there are you can roll over a capital gain into certain new assets, qualifying assets, but residential buy-to-lets is not there. It's not on the list.
No.
Furnished holiday lets, which is a really niche bit of property legislation, you can, but this is going to be. I think this is one thing that will be changed this afternoon. And I think most companies, I think the whole Section 24 Finance Act 2015, Finance Act number 2, 2015, was about, this is why everybody wants to incorporate their residential property portfolios, because they want to get back into tax relief for mortgage debt. And the only place that happens is in a limited company, not in a limited liability partnership. And a close limited company could be very easily added to the list of things where you can't have that happen. And I think that if they're going to do it with furnished holiday lets, they'll probably do it with close companies. That's my guess. I would if I was them, because it is creating a massive sort of tax motivated incorporation purpose, which they could kill off overnight. Less Tax for Landlords, by the way, were in the corporate, once it had got 95% or more of the profits of the LLP, were deducting mortgage interest as an expense when the debt belonged to the individual.
These guys went all out, literally. They've just put all different pieces of
you couldn't imagine. You're making a cocktail of the worst possible answers. They have produced an absolute blinding result here. But the sad thing, I don't joke about it, the fallout from the people haven't the penny again. The penny hasn't yet dropped amongst. It has with some, but there's a group are still adamant that Less Tax for Landlords will get them out of this, and they'll win their case, win the arguments. There are others that the penny has dropped where they've realised that they need to get away as quickly as possible. The revenue's advice is distance yourself as fast and far as you can from the promoters, because you need to make disclosure, you need to fix the tax liabilities, and we need to agree what we're doing with the stamp duty land tax position. So we are looking to build, we are book building, I've been doing lots of, at my cost, lots of conversations, Zoom meetings, seminars, webinars on this subject with the clients. And we've signed up a handful, but everyone's waiting for the budget. Everyone was waiting to understand what HMRC are doing. HMRC have appointed one person so far as the lead. Oh, he's the HMRC lead on the whole settlement process. One man. So I've spoken to him, so have others. So it's not privileged access. He sent me a list of 16 points that need to be answered on the disclosure, information and documentation. They want to know what one's analysis is for exiting, who introduced you to the scheme, full details of all the properties, the calculations on CGT, capital allowances, computations that have been claimed.
Wow.
And this is the other issue. The accountants so you've got, this is the revenue are really interested in this scheme for more than the obvious reasons. There's a lot of tax missing, which they will get back. That's easy, really. There's expenses that have been claimed in the P&L. So the accountants are related and are effectively the promoters.
Yeah.
So part of the plan was you buy the scheme from the promoter and use their accountants to do the accounting.
Sure.
And there lies conflict of interest, and the revenue are aware that the expenses in the P&L each year may be overstated, and that may be accidental or it may be deliberate. And that is serious, because that could lead to imprisonment for people preparing accounts, and it doesn't leave the taxpayer in any better position, but it just compounds the problems that are becoming apparent. People are still in denial. People have still got their heads in the sand because they don't want to deal with this. Human nature, you don't want to accept you've been sold a scheme and that all those savings you thought were there are just smoke and mirrors. None of it's there.
Exactly. I think human nature, human psychology plays a key role in all of this. When it comes to someone offering you a scheme whereby, okay, you're already paying a lot of tax, so now someone comes to you with a scheme, it sounds amazing, people will grab it, right? Human psychology. And so then when you get caught out that, okay, we've been ripped off or we've been scammed or it's incorrect, now you're failing to accept naturally again. So you look for the next way out. And these guys come out. So as we discussed, okay, CGT uplift, okay, we're in a bit of a pickle here. You're failing to accept. So, okay, let's introduce rollover relief, for example. It's just
the way this scheme was sold was you could do a case study, a masterclass on how to sell a tax scheme. So back in the day, they decided that they needed to get into the National Association of Residential Landlords. So in other words, the trade body. So they got the trade body to effectively put them on a preferred supplier list. I don't know how that happened. I'm sure it will come out later. They were at all the property shows. They were at Olympia. They were at Excel. They were on YouTube. And they landed one of the biggest private landlords into the scheme early doors. And I've heard from several parties separately, one of the reasons we did it, why did you do it? Why did you go into this scheme? And most of it is, well, we needed the tax relief on the interest to make it profitable. That was number one. Number two, it was recommended by our National Association. Number three, one of the biggest private landlords who's famous in landlord circles, I don't know, but he's famous apparently, he went into it, and therefore if he's in it, it's got to be okay.
Okay.
And those are your three drivers as to how schemes like you and I would sit here going, how on earth can anybody buy this absolute pile of nonsense? And yet,
it's all human psychology. Yeah.
It was very well done, very slick, very professional. It was headed up by a chartered accountant, chartered tax advisor. You know, you're thinking, well, okay, it's got to be all right. Do I need to do any due diligence? And nobody did. During the years, I had probably half a dozen calls over a year. People saying, "Oh, I'm looking at this. What do you think?" And I'd say, "Can I see the scheme documentation? Can I see the instructions and the opinion behind it?" "Oh, we'll go and find out." Of course, no, you can't. No, you can't see that. It was a no. Either buy it or don't buy it. We don't care, was the sort of response. But we're not going to let you do any not anybody else, certainly not someone like me, do due diligence on a scheme.
Sure.
And of course, you know, their response was, well, of course he's going to say, don't do it because he's professionally jealous. Okay, what? Professional, and that's how they did it. That's how they squared away the objections.
Okay.
Professional jealousy, because people, you know, they didn't think of it, therefore they're trying to just knock it down. And again, no, they're knocking it down because it's absolute garbage. And now the "I'm sorry, but I told you so" hat comes out, because now we can see it. We've lifted the lid, lifted the bonnet. We now know what it looks like. We know what's going on. We know where the problems are. The revenue aren't there yet. The revenue are taking legal advice as we speak to understand the trust side of it and the stamp duty land tax side of it. But we know we're already there. We're not going to tell them because it's not our. They haven't signed an engagement
letter. Exactly. We charge them a premium.
Would we do that?
We discussed two. So we said the CGT uplift into the partnership, the rollover relief, and then business property relief after 2 years. That's unacceptable because, you know, business property relief, the rules around it is more around the trading status, and the rest of it, if you have a property investment partnership, then
look, it's even, you know, this goes back to the problem with our legislation, problem with our tax system, all told. Property business. Everyone's got a property business. Not every business is a trade, and it's most likely an investment business. So why does that matter? Well, everybody's in a business of property renting. There's no tax benefit for that. If you've got a business that is actually a trade, you can incorporate and get rollover relief into the new company. Once you're in that company with shares instead of the assets, those shares are still investment property in your hands. They're not business. It's not business. So the different definitions in the tax code, the capital gains tax definition of business is not the same as the inheritance tax definition of business. And therefore, having a business it's not the end of the story. You've got to work out whether it's a trading business, and then does it move into the inheritance tax legislation and say, is that business a qualifying business for business relief, or business property relief as it used to be called, or is it just an investment asset? And the answer is property rentals is always an investment business for IHT.
Sure.
So, but people just say, oh, you're a property business, right, incorporate.
So basically, again, what they've done.
Yeah.
Again, what they've done is they've taken the legislation and they've bended it to sort of bring the maximum.
I'm yet to get my head around where they get that leap of logic that a property investment partnership, albeit an LLP, it doesn't matter. A property investment partnership, how is that trading to qualify for inheritance tax exemption?
Exactly. No, I think the logic for them is to use legislation. It seems that, you know, from these 3 points we've just discussed, is to use legislation to bring the most tax benefit, which, you know, to then sell to clients, basically. In terms of the final point you mentioned, the SDLT, I think my screen froze a little, so I missed perhaps the key part. But the SDLT issue, we have, you know, getting a bit technical, but we have the sum of lower proportions. So Finance Act 2003, I think is Schedule 15, sorry, whereby, let's say, husband and wife within a partnership incorporate into a limited company, also 50-50 husband and wife, you know, the Schedule 15 rules potentially come into play. What was the issue around that you mentioned?
Well, so Schedule 15 actually comes into play in the partnership. So if it's a property investment partnership, as set out in Schedule 15, which these come under the call them PIP, just for another acronym to add to the pile we've been dealing with. Property investment partnership. If you change your partnership interest, and partnership interest is defined in Schedule 15 or in the stamp duty land tax part of it, as just if your interest in the partnership changes, increases or decreases, that is that is a chargeable transfer
Sure.
of interest for stamp duty land tax purposes. So you go to a partnership with a company. Let's just say it's the two of you, you and a company. You put your properties declare the interest of beneficial ownership into the LLP. You own 100% of the partnership, the equity.
Sorry, Jeremy. Can I bring a scenario? So, for example, let's just say we have husband and wife that owns 10 properties. Let's just say valued at 5 million. Husband and wife, 10 properties, 5 million, jointly owned. They take this route and they transfer the £5 million worth properties into the LLP.
Yeah.
Okay. At that point, there's no stamp duty land tax. Why? Because nothing has really changed in terms of ownership. Correct.
And if as long as they don't change the equity, the capital ratios for 36 months, there's no retrospective stamp duty land tax on the original introduction.
Okay, so I don't think husband and wife is the best example, isn't it? Probably we should just say two business partners, because husband and wife get privileged in certain areas. But okay, let's just say two business partners, £5 million worth of properties, 10 properties into the LLP. As long as within the partnership agreement, everything remains 50-50 as it was prior, then we're okay. But if you change 60-40, then there's consideration or deemed consideration.
Yeah, and the disposal for CGT as well. So CGT. Interaction of tax is key to this.
Yeah. Okay. So then the next bit you mentioned about the corporate being involved.
Right.
What you said last night, there was a call. What was the discussion? What was the key questions that were asked?
Well, they weren't really. I mean, they were simply told you could put a corporate in there, give it all the profits, and it will pay corporation tax less, offset the mortgage interest. So we're back into scheduled section 24 again, being able to get deductions for mortgage interest. But the company, in most of the cases, hasn't got any debt. The LLP hasn't got any debt. The debt belongs to the individual person. And therefore, what business is that entity over there doing, claiming that on its expenses? It's not, it's wrong. It just doesn't follow. But the stamp duty land tax point is quite straightforward in this sense.
Sorry, Jeremy, just 1 second. I can't hear you. I'm going to leave and rejoin.
The stamp duty land tax point that has been completely overlooked until Spotlight 63 mentions it, and everybody's been saying, oh no, it doesn't apply, doesn't apply. Everybody thought it applied to putting assets into the LLP. Now, I've said it technically could apply, but if you've put the assets into the LLP correctly and don't change anything in an equity sense for 36 months, then there is no stamp duty land tax on going in. But what's been completely forgotten, and given what's been said is the case and is then completely wrong, it's not surprising. Changes in partnership interests include profits being shifted to other partners. And it's the sum of lower proportions calculation that's in play again. If you put the properties into the LLP and then the income was just, you took it yourself again through the LLP, the sum of the lower proportions is 0. And therefore, no stamp duty land tax on that either. But what's happened here is each year and every year, the profits are given to the corporate partner. So your partnership interest has gone from being up here to right down here. So the difference between what it ends up at, what it was and what it ends up at, is subject to a stamp duty land tax charge. And then
effectively, it's an annual SDLT charge, right?
Annual.
Wow. because every year the profits are moving, therefore
Your
your
interest,
interest
you're
is.
making a chargeable transfer of your interest in the
Mhm.
partnership interest. So
Wow,
that's been completely overlooked, and HMRC are taking legal advice on it right now.
that is extremely technical, I must say. That is
It's highly
extremely
technical,
technical.
but
Mm.
anybody that knows about partnerships and about profits in partnership, this is property investment partnerships. I mean, actually, it does extend into other partnerships. So it's not necessarily just PIP, but it's certainly it's set out clearly. They've not read, whoever's designed this scheme. I say
Yeah,
design.
as in no, it can only relate to property investment partnerships because SDLT on property, right? So any other partnership wouldn't have this issue.
Yes, but
As in a trading business.
there are other aspects because there is actually stamp duty. Some,
Stamp
some
duty at 0.5%.
yeah. So
Okay.
in non-PIP
Oh, okay.
partnerships,
Mhm.
if you change your partnership interest, reduce it, that is effectively there is technically a stamp duty cost to that. I mean, that's about as niche as you can get in partnership taxation. Most people
Wow.
don't bother with it. They don't notice.
Yeah.
They don't.
It must be made clear that partnership taxation, particularly around CGT, SDLT, IHT, is extremely complex. Even just CGT itself. I remember when I used to tutor a few students for CTA exams, the partnership questions are just a nightmare because as soon as the partnership interest changes as per the agreement, there's CGT issues, there's revaluations. If another property is brought in, another revaluation, there's always something going on, right? And it's quite interesting what you've mentioned about the annual SDLT charge because that's not something you hear about often.
No. Well,
Annual SDLT.
this is sadly sorry for them. It's news to all the customers of less tax landlords. They are, the penny is dropping on that point too. And as I said earlier on this conversation, that cost, if it stands, will bankrupt some of these landlord or some of the people in this structure because they won't be able to afford the CGT they haven't paid, the income tax they haven't paid, and the stamp duty land tax they haven't paid, the interest and potentially penalties.
Wow. Big bad situation. This SDLT thing that we just mentioned, that's just been agreed internally by experts, right? But HMRC, as you say, are still looking into it.
But yes, basically, we've looked at it. Dan Needle, Ray McCann, and a SDLT expert were on an open call last night. I wasn't there, but one of my clients, who is an ex-customer of Less Tax, rang me this morning urgently, saying, "Cool, I needed to speak to you right away," and he explained the upshot of yesterday's events. And I'm not surprised because I've had the orange book out on my desk for the last 3 days, reading when I get a minute, reading, rereading, and rereading because it's so complicated.
It is complex.
Try and understand the issue, but I think I'm there, and I think I get it, and I think the only saving grace will be if the original declaration of trust, whenever it was signed, isn't fit for purpose, and then this whole structure is effectively void. It doesn't exist. It can't exist because nothing could have been put into the taxes are all still wrong, but the one tax that falls out of bed is the stamp duty land tax on the profit shifting, because you have to effectively take it all back to day zero minus one, effectively, or minus day zero. And I've said the point on whether that document is fit for purpose or not. I think that's going to be what's going to be litigated over. It's got to be, because otherwise people are going to end up out on the street.
Sure. Okay. In terms of I had a question. I just want to mention that there's an SDLT expert known as Sean Randall, something like that. Is that his name? Have you come across him?
I think that might be the man that was out there.
I've heard of him a few times. But yeah, in terms of the for example, Property 118. Now, less tax for landlords I mentioned earlier that I have no connection with, but Property 118, I I did have connections with one or two of the staff members. No, not the owners, Mark, or is it Mark Alexander and Mark Smith as well, right? Two Marks. I don't have any connection with them, to be clear. But I did want to just check something, or your thoughts on something, which is around the fact that HMRC did open inquiries into many of Property 118's tax planning schemes since whenever they got into it. So HMRC did open inquiries and closed all inquiries as well. This is a known matter. Now, what are your views in terms of, okay, you've opened an inquiry, 20 plus, you've opened 20 plus inquiries and you've closed them without telling, Property 118 that they have to, they have to register the scheme. And now that certain other matters have come to light, now you're telling them to register a scheme. Isn't there a bit of a discrepancy there in terms of your open inquiries? Well, why did you mention it at that time? Now, just because private investigations have been looked into, and it looks bad on you if you're doing it now. There's a bit of a discrepancy, right?
Which is not unusual. You could similar. Why do they let the loan? Why the loan charge? Section 684 powers to go back. Morse on the loan charge. It was originally a 20-year retrospective. Lord Morse, now Lord Morse, independent review, chopped that down to 10 years back because 20 was excessive. The law wasn't clear. One would argue the law's never been clear, but the law wasn't clear enough. And then they dust off 684 powers and go back to the people that thought had escaped in the earlier first 10 years, and now back under. We've got hundreds of them coming through the door here. 684 inquiries wanting help because the revenue have decided that they'll ignore Lord Morse. Whether he was independent is another point, but I think I know where I stand. They're going back 20 years. They want their money. So yes, you see it sometimes where they look at a scheme, they open it, they close an inquiry. It's about being joined up, and I think if you expect something like the revenue to be HMRC to be, firing on all cylinders all the time, I think it doesn't. It's a very dysfunctional organisation. We know this. We have a lot of ex-HMRC people here, some ex-fraud investigation service people. We have good friends and contacts in the revenue who are, doing the best. But I don't know that it's going to create a problem for them where they've closed an inquiry, opened and closed an inquiry with maybe no tax to pay, and then they want to have another bite.
Exactly. That seems unfair to me, to be honest.
Well, it may be that they won't be able to have another bite on those that they've closed.
Right.
They would be challenged, wouldn't they?
Exactly.
So it's an unusual one, but it's no comfort for the rest of them because, as in the ones that weren't inquired, because they will be hit with what they're doing, what they said they're going to do with less tax for landlords, because of course you can go back and repair probably up to 4 years of 2 years online and 2 more years on paper. You will repair some accounts and tax returns if that's what you want to do. That's an answer which we've looked at. But you've got to go back earlier. Some people are going back to 2016, 17.
Okay.
Right. And so what the revenue are doing are issuing, they said they're going to issue discovery assessments to protect their position on those earlier years, so they don't fall out of time, which is expect them to do. But it's going to be unpleasant again because I dealt with a case a while ago, which was a completely different tax avoidance scheme. It was a pension transfer plan sold by AML. No, sorry, it was Aston Court Chambers. James O'Toole was the architect. He's apparently in the Seychelles these days. Can't come back to the UK because he won't be. He'll be welcome back, but he'll be in handcuffs by the time he gets through the airport. That was a discovery assessment dated 2014. And then they sat behind a case, Clark case, that went to the Court of Appeal back end of 23. No, sorry, back end of 22, early 23. It finally went against the taxpayer, so it was a pension, basic pension liberation scheme. The penalties are 95%, so 40, 40, and 15. And the IFA that brought me the case said that his advice to the client, the taxpayer, who was now the son of the taxpayer, because the taxpayer had deceased, died partway through the court case. It wasn't his case, but had died a couple of years before. And the estate had been distributed as well. The advice from the IFA was that the discovery assessment had gone stale. And I suggested that that was probably not right.
Oh, sorry. I just lost you there. I lost you at the part where you said
so the discovery assessment was stale. And I said, no, after the tooth case, you've not got, there's no concept of staleness in discovery. So the fact that the revenue have sat on the case since 2014 and we're now at 2024, and you've got effectively a follower notice because they won their case. They've sent all the people in the scheme the bill, and this bill was £1.5 million, I think, to the estate because the taxpayers died partway through. Because the estate was positive when distributed, the family, who were the executors, are liable for the bill. So this whole thing about, and some people say, oh, how quickly do you think this is going to be done and dusted with the revenue? I said, they're in no hurry. So they're charging you daily interest. They're not really going to there's one man been appointed the lead, and he's going to then have to build a team. And of course, it's going to go across two teams because it's got wealthy. Some of these portfolios, some of the people I've been talking to, we're looking at property values up to north of £20 million. So these are going to be the nuts. We've got some who have got 2-3 properties worth a few $100,000. So it's still going to be painful. They might have to sell the properties to pay the tax bill, but they might survive. But some of these bigger players who are shifting millions of pounds a year in income against a substantial portfolio, and for them the real worry, they're not actually flapping about the tax at the moment because they haven't quite got their heads around it. They're worried about the lenders pulling the debt. So there's, I suppose this would make I'm sure this scheme, well, perhaps the two of them, but this particular one, less tax, will be studied by chartered tax advisor students and accountancy students for decades to come, I think. And we are really just we haven't, we've done the first inch of probably a marathon.
Yeah, because that SDLT case that you've mentioned, or the element, just thinking about it, I can see the technicalities that would be involved and the different calculations that would need to be looked at, all the moving parts, that in itself. I think the other points, so I wrote 4 points when you were speaking, which is the CGT uplift. I think that's quite straightforward, black and white. The rollover relief, again, black and white. Business property relief, for me, black and white, but they may come across, I don't know how they're justified, but this SDLT thing, I wanted to ask you in terms of, it might be the elephant in the room for some people, this question, which is tax policy networks, or is it tax? Dan Needles, what's the name of it again? Is it Tax Policy Associate?
Policy Network.
Tax Policy Network. Okay. What is his sort of view and aim for his organization? Because obviously he's affected he's affected. He's brought change in terms of Spotlight 62 as well previously, which was around the school fee tax planning, and now Spotlight 63. Maybe we should get him on this podcast at some point. You can make the intro, Jeremy.
I'm going to say, I mean, I can't talk for what his
exactly. Yeah, no, it's true. It's true.
But I can, you know, I've spoken to him, spoken with him. I know, obviously, I know of his career as head of tax at Clifford Chance. We all know that. I know people that work with him who are now at the bar, who were colleagues of his at Clifford Chance, and he has been the topic of discussion amongst tax accountants and tax advisors and tax lawyers out at networking, social events. His name comes up constantly.
Exactly. Yeah.
So he's certainly positioned. He's done a very good job of positioning himself front and centre in the public eye. His mission, I believe, and he'll tell you what it is himself, I'm sure, but he is perhaps a little, well, knowing the industry as he does, probably as well as I do, and maybe you do to a degree as well, perhaps fed up with seeing regulated people ripping off the public. I think that's
unregulated individuals and companies.
Well, so regulated people ripping off, members of the public who are not represented or not regulated, and nobody doing anything about it.
Okay, although Property 118, they were broadly speaking unregulated, right?
And they're different, but again, this also, I mean, this is another pet subject of mine, which we could have another half day on, I would imagine. Regulated and unregulated accountants and tax advisors.
Mm-hmm.
It's the public have got no idea. The public don't know the difference. The institutes and associations try their hardest to differentiate and point people in the right direction, but it's not getting through. The public, if you say you're a tax advisor, they go, great, you can help me with my tax. They don't ask you to see your certificates and your training record and your license to practice. They're not bothered because you don't need it.
And unlike the legal industry, right, which is a lot more regulated, I think the tax.
Well, you can actually say that anybody can call themselves a lawyer.
Okay.
You can't call yourself a solicitor.
I'm pretty sure they're a bit more, as in, correct me if I'm wrong, but my understanding was they have to be regulated with the SRA, as in everyone has to go through.
If you are a solicitor or a barrister.
Okay. But then anyone can call themselves a lawyer. Okay. Interesting.
Which, again, problematic.
Mm-hmm.
Not everybody can call themselves a doctor. Because otherwise, well, in theory, you probably can. But no, I think Dan is definitely on a mission. That would be my interpretation of it.
Definitely.
And I think when he got his teeth into Nadine Zahawi, the Right Honourable, or not so, MP, I thought that was, that kind of showed where he was at. He's not, because of his legal background, he's not afraid to make waves, put his head above the parapet and upset the wrong people, or the right people, depends which way you look at it. But we got to know him and speak to him on occasion when he's just fact-checking stories.
Okay.
Because of the nature of the client base we have and our industry knowledge here at WTT, which is dealing with schemes, failed promoters, failed everything, and picking up the pieces for the taxpayer, we have got a lot of intellectual property that we are happy to, certain circumstances, share to make sure that when he does launch a story or launch an attack on a particular sector, that he's not going off the tangent, or he's not been sold or told. Well, again, it's our opinion, but as I keep saying to people, you get an opinion, it's just that, it's an opinion. Some have a different opinion. It's Doesn't mean you can sue somebody if their opinion is wrong. It's an opinion.
Yeah.
So,
And yeah, a lot of the times you have clients, they'll ask you things like, what will HMRC think, for example? And my answer to them is always, I don't know, as in, no, sorry, it's more around like they'll ask me for advice, and it's around what will HMRC think. Now, I'm giving you my advice. We have no idea what HMRC would think, isn't it? Ask them.
exactly. Well, they don't give advice. This is I've been trying to tell these clients
Yeah.
of tax that they're saying, well, we'll wait for the revenue to tell us what to do. I said, you'll be here
No.
till I'm
Yeah.
dead. They won't do it in a hurry. They're not interested in speeding this process up. Look at the time it takes to litigate, the time it takes to go to tribunal. It's years. And each day, interest is running. The clock is ticking. So they're in no rush, and they'll take their own sweet time about it. But Spotlight 63 is, I said, it's a blueprint. It sets out a timescale, and I now have the 16 questions or bits of information that they expect. This is I said, can I have a process document? The information and documentation we are seeking from customers as part of any disclosure is as follows. So it's all of that, and then the last paragraph says, oh, and anything else that might be helpful.
Might be relevant. Is that from the lead of this investigations team?
Yeah.
Okay. Excellent. Jeremy, I think we can probably easily talk for another 2-3 hours. Very easily. Yeah, so just before we finish, a bit slightly different angle. I wanted to ask, this is for myself first and foremost, and then others that are watching. What's your advice to, someone like me? I would still class myself as fairly new in the game. Advice to other tax practitioners, developing themselves. What is your advice, please?
That's a good question. You have to continue with an open mind and an inquiring mind, and educate yourself. If we're regulated people, we have a minimum CPD, continuing professional development, another acronym, requirement. Don't take that as the sort of the limit. That you should be doing much more than that. I immersed myself as an accountant, so qualified as an accountant, and then flipped into tax. I did the CTA exams when my children, one child born, one on the way. I passed 3 out of 4 papers. I did an answer, group restructuring. I did an LLP structure as my answer, and I didn't get any marks for it. And those were the days, because it was off the marking schedule. I should have just done a corporate group, but I was trying to be clever, and it backfired. I didn't had to pass all 4 at once. I got 80, 80, 80, and about 30. So I had to go and resit the lot, and I decided I didn't have the time at the time, and I have never gone back to do that. One regret. Anyway, but I haven't not been doing my training, but I immersed myself very quickly on in my solo career. I started when I was in partnership with others, but carried it on, training with the tax bar. So instead of attending accountancy updates and courses, I used to do those. I didn't do a lot of accounting, to be fair. I spent all my time on seminars, webinars, face-to-face training, away days, away midweek stuff with tax chambers, be it Old Square, Pump Court, Gray's Inn, all of them. So did my learning with the barristers and the QCs as they were then, but KCs as they are now. And there you make friends, contacts. So if you're wanting to get around in this tax industry, you've got to know your stuff. Never disrespect other tax advisors, and keep learning and keep networking with fellow professionals, because not everybody, well, nobody knows everything about everything. And there's enough work, and there'll be more, and it's getting busier and busier. More enough work to go around everyone. And if you become known for a particular thing, so my thing was, is partnership and partnership tax. Sometime in your career, it suddenly becomes you become the go-to. When sadly, I've seemed to have picked up the less tax not sadly for me, sadly for the clients involved, because it could be so easily avoided if someone had actually, well, if the regulators were looking at what their members were up to, which is where Dan and I are similar in outlook. But that's my advice for someone in practice, is to open mind, keep learning, and do much more than the minimum CPD, because you need expert knowledge, and then just also try and be. I say to my children, or my children say to me, "You're just boring and annoying, Dad," and I just agree with them. Yeah, it's fine. You don't want to sit next to me at a dinner party.
You just agree with them, give them the boring answer.
Yeah, absolutely.
Instead of the back and forth.
Yeah, they're just accounting and tax is boring and annoying, and that's what I say to people when they say, "What do you do?" I say, "Oh, it's just boring and annoying, accounting and tax." It's fine. We move on and talk about more interesting things.
I would say that's like the sort of stigma that's attached, but I genuinely don't find it boring. As in, for example, I would definitely find audit boring. Audit, like, I would happily say that's boring. I'm sorry to say, with apologies.
There are many auditors out there who have just fallen off their chairs going, "Oh my God, how dare you!"
No, as in, I'm talking about from a repetition point of view. For example, tax, as you mentioned, always learning, always keeping up to date. Legislation is always changing. All the budget, the autumn statement. It's not there for no reason. It's there for us to then capitalize on, pick up on what's the difference. For example, the R&D scheme. There's massive changes coming in next month. There were changes last year. All schemes.
Can I add? Read the cases as well, because I was doing a stamp duty land tax. This was about a property purchase, about multiple dwellings relief, and had to start going through the recent cases. So I was reading some very fascinating cases about what people were trying to claim as a dwelling and what wasn't, which kind of. So I've got a £4 million transaction where they're trying to claim three dwellings in the bundle, and I got to two quite quickly. The house, that's easy. That's one. So anybody do that. The 2-bedroom staff flat above a garage, as in car garages, not as in a petrol station. So that's two, and then there's a pool house, as in swimming pool, not as in the table game, which on the face of it looks like you've got to go through the garden to get to it.
Okay.
But then I noticed on the Ordnance Survey map there was a road leading round to the back of it. So I rang the estate agent out the blue and said, "Have you got any pictures of the side access from that road to the pool house, please?" And they went, "Who on earth are you?" I said, "I'm tax advisor for the buyer." And they went, "Really?" And so they're going to send someone around and take some pictures, because if it's got access, separate access, it's already laid out enough to turn it into a residence. It's got its own utility supply. I think there's a potential, but this is another example of you suddenly get an instruction or a bit of work, and then you've got to go and quickly educate yourself and get up to date on the latest cases of multiple dwellings relief. And what worries me, and the barristers always said to me, if there's a lot of case law on the subject you're looking at, give the client a health warning. Because if it wasn't a technical issue, or it wasn't a contentious issue, there wouldn't be loads of cases on it.
Exactly.
About being logical. So if there's only one stamp duty case, you think, okay, well, this isn't much of an area. But when you look at it and there's about 50 in the last 3 years, you're crikey, the revenue are busy in this area. So clearly there's a lot of dispute and debate about what isn't a dwelling. And of course it's a minefield, but there you go. That's what we get paid for, to get the
exactly
advice right.
Exactly. No, we really appreciate your advice, and we really appreciate your time as well. Thank you for sharing your insights, your knowledge. It was a very interesting discussion, very relevant. So I think the viewers will have found it interesting as well. And we should schedule another episode in about 4 months' time or something. See the latest updates. I think that'd be beautiful.
Happy to put up with me for another couple of hours. I'd be more than happy to pick a subject, and we'll give you an update on what's happening with. We might know a bit more about our landlords clients.
Exactly.
No, thank you for having me, and I've enjoyed it. Now it's to have a quick break, and then the budget. The budget.
Oh yeah, exactly.
So
pleasure, Jeremy. Catch up soon. Take care.
Have a good day.
Cheers. Have a good day. Cheers. Bye.